Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy. Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy.
Good morning, everyone, and welcome to Financially Raw, Thursday morning, 10 o'clock, as per usual. And I'm looking forward to having another interesting discussion with you and a show. We're going to play some music. For those of you who are listening on Berg Studio, we're going to have our band of the week. And this week we decided to have U2. I haven't had U2 on yet as a band of the week. So, very excited to share some of those songs with you. I mean, they are one of the greatest bands ever. So I'm going to listen to some U2. And then those of you who are watching on our social media channels, you will be able to watch a video, and we're going to talk about retirement annuities in that video. How do they work? And then also the negatives of a retirement annuity. I will share that with you as well. As per usual, you are welcome to give me a shout out. If you are live, you can give me a shout out on Berg Studio. There's a little shout out button at the top. You can just press there and say hi. I've got everything on my computer, and you'll be able to chat with me directly in studio. If you are watching on one of our social media channels, whether it's Facebook, whether it's YouTube, Instagram, you are also welcome to send me a message, say hi, and I will be glad to respond. Also, if you have any questions or any comments of what your thoughts are on the topic for today, you are welcome to share that with me. So what are we going to talk about today? So the topic for today is, will saving 15% of your salary be enough to retire comfortably? So there's an article that was posted on the Business Tech website that I'm going to share with you and work with you through. And they talk about if we need to retire that rule of thumb. Is 15% going to be enough? And I will share my thoughts on it as well. And through my experience over the last 22, 23 odd years in the industry. So I'm very excited to share that with you and engage. You're welcome to ask me any questions on the matter. And if you don't agree with us, you are also happy to, or we're happy that you could put a comment, tell us why you disagree, and I will give you my thoughts on it as well. So before we get started with the topic for today, let's have a listen to some music. Like I said, on Berg Studio, we're going to listen to U2. I keep wanting to say YouTube. U2, and the song we're going to start off with is With or Without You. Okay, guys, those of you who are on the social media, I'm going to put our video on that you can listen to or watch while we are waiting for the song to finish. So let's look at retirement annuities first. Now, if I still remember my dates correctly, the first retirement annuity was only launched in South Africa in 1957. I could be wrong. It could be 51. It could be 56. But if I remember correctly, it's 1957. I tried this morning to go and find the exact date, but I couldn't find the exact date. But it was in the 1950s. So we tend to think that these kind of savings vehicles and the way we prepare for retirement has been around for generations. And actually it hasn't. Actually, these retirement annuities, these products have only been around for about one generation. So if you are told that this is the solution for retirement, it's not because people have proven it over and over and over again. In actual fact, if you look at the proof, most of these products don't really solve the retirement crisis, or the retirement problem. But it was launched in 1957. The first company who launched a retirement annuity in South Africa was Liberty Life. They then, all the other companies came on board. Legislation was passed, etc., etc. So what a retirement annuity actually is, it's like a personal pension fund. So it works similar to a pension fund you would have at work. It's just you contribute towards it personally, and initially it was created and developed to add to pension funds that people have. Over time, group schemes, pension funds have become less predominant. In the past, most companies, especially big corporations, had their pension funds. Now more and more companies, especially small medium enterprises, don't give group schemes, which means the role of the retirement annuity has become more and more important in people's retirement planning in their lives. So what are the benefits of a retirement annuity? The first thing that everybody tells us about is that you get tax benefits from your retirement annuity. You can claim back your premiums that you pay from tax. But what does that actually mean? So the first thing you need to understand is that there's a limit to how much you can claim back from tax for your contributions towards your retirement annuity, and for that matter on all your retirement savings. So that includes your pension fund at work as well as your retirement annuity. So in total, you cannot claim back more than 27.5% of your total gross taxable income. So taxable income. So your gross taxable income, 27.5% of that you can claim back from tax for retirement contributions. But that includes all retirement contributions. It includes your pension fund, and it also includes your retirement annuities. But there's also a maximum limit of 350,000 Rand per year. So if 27.5% of your taxable income is more than 350,000 Rand per year, then you can't claim more than 350,000 Rand per year. Now, let's quickly talk about how you actually claim it back, because people think that if I put 1,000 Rand a month into my retirement annuity, that's 12,000 Rand per year, I'm going to get 12,000 Rand back at the end of the year from tax. That is not how it works. You don't claim your premiums back. What happens is any contribution you make towards your retirement annuity reduces your taxable income, and you will get the benefit of a lower tax that was necessary for you to pay. So I'm going to explain it and try and do it in simple terms, or as simple terms as possible. So let's say, for example, you earn 100,000 Rand and your tax on that 100,000 Rand is 20%. So 100,000 Rand for the year, 20%, that is 20,000 Rand tax for the year that you have to pay. But you go and you contribute 20,000 Rand for the year towards your retirement annuity. So that means your taxable income has now dropped from 100,000. Let me just go back to our full screen. Welcome back, everyone. That was U2, with or without me. And those of you who are listening or watching on social media, we watched some information about what is a retirement annuity. And in our next music break, we will continue with that video. So let me start today, and we're going to talk about this article. It was posted in Business Tech. A staff writer wrote it, and it says why it's time to retire this rule of thumb in South Africa. So according to them, it is time for us to stop looking at retirement and using this rule of thumb. So let's see what they say regarding this. So they say, for many years, the retirement rule of thumb advised citizens to diligently save 15% of their earnings over a 35-year period in a growth portfolio to generate an income sufficient to comfortably see them through their golden years. So when I came into the industry in 1999, this was already the rule of thumb, and this was already what they were telling people is go to work, get a good education, go work for a company. When you're 25, you start saving for your retirement. You save 15% of your gross earnings every month, and by the time you are 65 years old, you'll be able to retire with at least 70% of your final salary. Now, that for me was already an issue because firstly, and we'll look at it now when we look at some of the graphs, is that very, very few people take that straight road to retirement. They start working for a company, they never have a break in service, and they just work through their time for 35 years and continuously put away 15% of the income. I think if 1% of the whole population does that, it is a lot. So I don't know how they can use that as the recipe if 99% of people is never able to do that. Okay, but all rules of thumb should be reassessed at regular intervals, or else we really just holding thumbs in the hope that they're still as relevant now as they were 10 years ago, says Ruan Burger, Head of Client Strategy at Momentum Metropolitan. So this is a person that is quite high up in the financial services industry. And this is one of my issues with the industry. I always say all of these products, these savings plans, even the risk is all sold on hope. We go and we say, well, I hope I'll be sorted out if I put my money in a retirement annuity. I'll hope I'll be able to retire if I put my money in a pension fund. But we want to take people from hope to certainty. You need to understand what it is that you have, what the actual expectations needs to be, and what you can achieve with what you have in place. And since 2002, even before when I started in the industry, I've been saying that savings alone is not the answer. Now, after 20 odd years in the industry, people are starting to realize that what I've been saying for over 20 years is actually the truth. And the mainstream people in the financial services industry are now starting to talk the same language. So let's test the rule of thumb, the reasonable returns. The current rule of thumb assumes the following: reasonable returns over the member's working life, with monthly contributions covering 15% of earnings. At least 35 years of work with no dipping into retirement savings when transitioning to another job, and a roughly 20-year retirement period. So let's just look at that paragraph. So the first thing is he talks about reasonable returns. Now that for me is so open-ended. What is a reasonable return? Is a reasonable return to just get 1% more than inflation? Is a reasonable return inflation plus 5%? What is reasonable? So again, when we look at the planning, they're not saying exactly, they're not giving you the roadmap exactly. Then they say 15% of your earnings need to be saved at least 35 years of work with no dipping into retirement savings. So, and this is something that I see so often. People work at a company for 5, 6, 7 years. They then resign, they move to another company, and then they take their retirement savings and pay off their unsecured debt with it. But then they start from scratch again, but then they start going back into debt, and that cycle continues. And then they talk about roughly a 20-year retirement period. So they're saying, well, 35 years of work, let's say that gets you to 65, then you have a 20-year retirement period up to 80, 85 years old, and then they expect you to pass away. Now, to test the first component, we turn to the Johannesburg Stock Exchange. So this is the JSE, where we trade in equities, and we look at the all share index. So that is all the shares on the Johannesburg Stock Exchange. What is the total growth on the stock exchange? To look at historical returns relative to inflation over the past few decades. So they start here at 1931 and they go all the way to 2019. It's a little bit difficult to see because it's not the greatest picture. Let's just see if it opens the picture. and makes it a little bigger. It doesn't really make it much bigger. But yeah, if we look at that graph, you'll see the 7-year moving average, the 20-year moving average, and the long-term requirement. So let's see how they explain it. In the graph above, the red line represents the long-term investment growth requirement. So if you look at that, if you want to retire, they're looking at 7.5% return. That is total return. While the black line shows the 20-year moving average, so the assumed retirement period. The more volatile gold line reflects the 7-year moving return. So that is the average return over a 7-year period. And the 7 years is the average amount spent with one employer. Okay, to provide for a decent retirement, we need returns to beat inflation, which is a guide for how your retirement expenses will advance. So if we look at that line, the red line, and you look at the black line, you'll see how often it is below that line and you're not getting that inflation beating returns. The higher your returns above inflation, the less you theoretically would need to contribute, as the compounding effect of interest would effectively save money for you. So what they're saying is, and that makes sense, is the higher your returns, the better or the less you have to put away, because the compound interest will get you there. The problem is, for many years now, our JSE, our the all share index has not performed higher than inflation. It has been dismal for close to the last 10 years already. Consider that with every rand you spend in retirement, 33 cents comes from your contributions and a whopping 67 cents from your investment returns. So if you've saved all your money and you've now retired, you've got 1,000 rand, 330 rand would be your own money that you've saved, and 670 rand of that 1,000 rand would be money that you would have had to get through your investment returns. So what they're basically saying is that 2/3 of your capital that you need to save at retirement needs to come from growth in your investments. And again, that's not what we're seeing, demonstrating the power of the compound interest effect in action. To put it another way, you would have to double your saving rate to 30% if your investments are just beating inflation. So if they say the rule of thumb is 15% for 35 years to retire with 70% of your salary, if it's only basically beating inflation, you immediately have to save 30%. Now, already only about 1% to 2% of people save 15% for 35 years. Now they're saying you need to double it if it's not beating inflation. And if you look at what the all-share index and equities have done, it hasn't beaten inflation. And secondly, then the government brought in what we call Regulation 28 that limits the exposure you can get. So you cannot just go into equities to give you the highest returns possible. So they still curtailing the amount of return you can get. So the question is, has the equity market delivered the returns you need for a decent retirement? So when I come back after our break, we can have a look at that question. We can continue a little bit more in depth into this and have more of a discussion. So again, guys, you are welcome to ask me any questions about this topic. Give me your thoughts on it. And then also, if you want to give me a shout out on air, you are welcome to do so. Let's go for another music break. For those of you who are listening on Berg Studio, we're going to listen to another U2 song, which is I Still Haven't Found What I'm Looking For. And then on the guys on our social media, we're going to continue watching. So let's look at a lower tax that was necessary for you to pay. So I'm going to explain it and try and do it in simple terms, or as simple terms as possible. So let's say, for example, you earn 100,000 Rand and your tax on that 100,000 Rand is 20%. So 100,000 Rand for the year, 20%, that is 20,000 Rand tax for the year that you have to pay. But you go and you contribute 20,000 Rand for the year towards your retirement annuity. So that means your taxable income has now dropped from 100,000 Rand to 80,000 Rand. 20% of that 80,000 Rand is 16,000 Rand, which means you've paid 20,000, you only had to pay 16 because of the credit from your retirement annuity, which means you will get a refund of 4,000 Rand on your tax. Okay, so if you want to calculate, the easiest way is to take your contributions, calculate your average tax rate, and that's something we might want to discuss in a different topic. Exactly how much tax do you pay? Because people tend to think their tax is a much higher percentage than it actually is. But take your average tax rate and multiply your contributions by your average tax rate. So if you're contributing 20,000 Rand a year, your average tax rate is 20%, you will get back approximately 4,000 Rand from the 20,000 that you've contributed towards your retirement annuity. So you're not getting all the premiums back, you're getting a percentage back from your retirement annuity contributions. Now, what we always say is that what I suggest is that you take that amount that you get as a tax credit and you put it back into your retirement annuity, because that money you're getting back as a tax credit is actually free money, and the moment you put it back into a retirement annuity again, you're getting a tax credit on that tax credit again. So if you take that 4,000 Rand, you put it into your retirement annuity, you're getting 20% on that 4,000 again, which is another 800 Rand. If you put that back into your retirement annuity, you're getting another 20% on that 800, which is another 160 Rand, and so on and so forth. So you can continually put that money back into your retirement annuity so that you're getting free money going into your retirement annuity over time. Now, the reason you can do that is because on a retirement annuity, you can contribute towards it on a monthly basis, which most often is the case. People take out a retirement annuity for 1,000 Rand a month, 2,000 Rand a month, and every single month the money comes off your account. Or you can do it as ad hoc contributions as well. So you can say, listen, I want to add 10,000 Rand or 20,000 Rand or 50,000 Rand as a once-off contribution towards my retirement annuity. So when you get these tax credits or this tax refund, you can immediately take that tax refund and just contribute it towards your retirement annuity again, and it will count towards your tax benefits for the next tax year, the next financial year. Just a quick shout out, Fricky, and the new interns at our office all say hello. Hi Fricky, hi new interns, great for you guys to listen to us. Welcome. For those of you who don't know, we run internship programs at iRetire and Retire Rich and Happy to teach some of the young people some experience in our industry, in running a business, in the different areas so that they can get practically prepared for the future. So welcome, and we hope you are enjoying your time with us. Okay, so that's the tax benefits. Now, another tax benefit that people don't often explain with retirement annuities is that your retirement annuity is taxed at a lower rate internally than another type of investment. So for example, another investment is something like an endowment. So if you take 500 Rand a month and you put it into an endowment product, it's a savings plan, and you put 500 Rand into a retirement annuity, and both of these. Welcome back, everyone. For those of you who are on Berg Studio, that was another YouTube song. I still haven't found what I'm looking for. And then on, you guys watched a little bit of information around retirement annuities. Okay, so let's continue with our article that we are discussing why it's time to retire, this rule of thumb. And the rule of thumb they are talking about is the fact that you need to put away 15% of your income to retire comfortably. So let's continue with our discussion. It says, so the question is, has the equity market delivered the returns you need for a decent retirement? Now, looking at the graph, in recent times, the answer is no. Like I said earlier, the last 10 years has been dismal. The gold line is well below the required 7% mark. So let's quickly go have a look at that gold line again. If you look at the red 7%, how often is this gold line underneath that 7%? While the black line inches downwards. Inflation is rising, and with it interest rates, which will increase the cost of credit and stagnate economic growth. And this is what we are experiencing at the moment in not just South Africa, but in the world. I mean, the US interest rates and inflation is sitting at like 9%. We had in the last quarter, our inflation rate was over 7%, 7.4%. So inflation is rising and the returns are just not there. Given the recent past performance and poor prospects, it seems likely that additional amounts will need to be saved to make good the shortfall. So here's my issue with the industry. For the last 20 years, I've been telling people, more than 20 years, I've been telling people that savings alone won't get you there. Now they are starting to realize that savings alone won't get you there. And what is the solution? Well, you need to save more to make good the shortfall. Guys, we cannot solve the problem with exactly the same strategy that created the problem in the first place. You need to do other things as well. So let's look at 35 years of work and a 20-year retirement. Is it an outdated thumbsuck? So if you work for 35 years, let's say you start working at 25, you work for 35 years, you retire at 60, and then you have 20 years to live after retirement. Is that an outdated thumbsuck? Well, let's look at that. To determine whether a 35-year working life is enough time to provide for a decent retirement, we must interrogate the current retirement age of between 60 and 65 and the average lifespan of a person. I've used the United States example in the graph below simply because there are no clear stats available for South Africa. And the average American has a comparable life expectancy to a South African. So similar levels of obesity, morbidity, etc. So we're very similar to the US. So if you look at that graph, the shaded areas represent the average retirement age, while the gold blocks indicate the retirement period. So depending on what the life expectancy was. So if you look at the 1900s, the retirement age was deep in the 70s. Then 1910, it went down to like mid 70s. 1920, went a little bit down. 1930, it started moving closer to 70. 1940, it hit 70. 1960, it became about 65. By 1980, it's gone down to like 62, 63, and it's slowly climbing back up, and it's now sitting very close to about 65 years old. One glance at the graph should give you an idea of the problem. We are living longer and our working life is getting shorter. The catch, we need more savings to comfortably see us through the golden period. So again, everything is about you need to save more. Well, if you are 55 years old or 50 years old and you don't have the time anymore, how do they expect you to save more? And save enough, because the time is not there. So we need to find another solution for this problem. Let me just quickly get myself up to speed here again. Okay, so if you look at the golden period, in 1900s, people worked basically till they die. You just worked until one day you woke up and you were dead and you don't work anymore. In 1910, there was a very, very short retirement period. From the 1930s, 40s, retirement became a longer period. And then here in the 1980s, it was almost 50% of your life was you needed to be in retirement. And then it started, the retirement age started picking up, but our life expectancy increased. So again, we're almost halfway now from where they say you should work and then retire. And saving is not going to solve that problem. In the early 1900s, you might have lived to around the age of 76, but you would be working all of your time on earth. In 2010, and thanks to modern medicine, our life expectancy climbed to around 82 years, with the average retirement window being 17 years. So if your retirement contributions amounted to 15% of your earnings and you saved consistently over the whole of your working life, you were probably in for a decent retirement. Again, I still don't agree, because probably 1 or 2% of people actually get there. But if you roll this forward to a 2040 projection, we would see the average life expectancy rise to 90, which would mean providing for 26 odd years of retirement. 15% will no longer cut it. You would need to be saving approximately 30% of your monthly earnings. So what they're basically saying is everybody starting to work now have to start aiming to save 30% of their monthly earnings and not 15%. And those of us who are already at age 40, 45, 50, they're basically saying, sorry, but you are screwed. There's no way with the life expectancy that you're going to save yourself into retirement, and they do not have alternative solutions. So we recognize that South Africans will struggle to set aside more for retirement savings. It seems clear we need to reverse the trend and to start to move up our retirement ages along with the improvements in life expectancy. So what they're saying is we need to start working longer before we retire. Now that's what I've been saying for many years. We need to redefine what retirement means. For too long, retirement meant the day that you stop working, and that's everything that's built around that graph, is to focus on the day you stop working. So you work your whole life, you get to a point, you retire, and now you do not work at all. Our definition for retirement is the day that you work because you want to work, not because you have to work anymore. So we're basically saying is get something, build your financial security to such an extent that you want to work the rest of your life, want to be active the rest of your life, but you don't need to from a financial perspective. Now in South Africa, with our high levels of youth unemployment, this will of course raise interesting debates. So next topic we're going to discuss is rewriting the rules. So what are the suggestions and the solutions they have come up with, and then I will share with you my thoughts on those suggestions. So let's go for a quick music break again. Those of you who are listening on Berg Studio, we will listen to Sunday Bloody Sunday from Berg Studio from U2, and then we, the guys watching on our social media, we will go and talk a little bit about the mistakes or the problems or the negatives regarding retirement annuities. So let's quickly chat a little bit about the negatives on retirement annuities. So the first negative of a retirement annuity is that there's no access to funds. Once the fund in your retirement annuity reaches 11,000 Rand, so the maximum that's in that fund is 11,000, you can withdraw the money in your retirement annuity. But once it reaches 11,000 Rand, you cannot access the funds in that retirement annuity. It is fixed there until age 55. So a lot of people ask me, but if I've now contributed to my retirement annuity and I can no longer contribute, how much or do I lose the money that I put towards that? So the answer is no, you do not lose the money that you contribute towards that. What will happen is your funds will build up. Then if you cancel, it goes what we call paid up, that retirement annuity. So there will be penalties because the cost is calculated over the term of the investment. That penalties will be deducted from your fund value, and the rest of your money will stay in that retirement annuity until you are at least 55 years old. It will still be invested in the market, so you will still receive the returns on the investment that you have put into the market. And then when you get to age 55, you will be able to access those funds. And that is the second thing about the retirement annuity. The earliest you can access your funds in your retirement annuity is age 55, which is early retirement age. So then only can you access the funds in your retirement annuity. But what happens if you have a paid up retirement annuity? You have 200,000 Rand sitting in an RA and you are not contributing towards it anymore. And now you want to start a new retirement annuity with another company and you want to start contributing again. What are your options? So your first option is to just leave the money where it is, because it is invested in other funds than what you potentially would invest in the new fund, which means you've got some diversification in your portfolio. But you can also choose to move those funds from that old retirement annuity into the new retirement annuity. So instead of you starting at zero, you're now starting at 200,000 Rand to invest, and you then just contribute on top of that. That is what we call a Section 14 transfer, and it is a allowed transfer in the industry that you can move from one fund to another fund. Just keep in mind that it takes time for these Section 14 transfers. So your financial advisor, don't get upset with them if it takes 3 to 6 months for this money to be transferred. It is quite a timely process. And it's not the financial advisor, not the broker's fault. It is usually the industry or the companies that take a long time to do these transfers. Inside your retirement annuity, you are invested into different funds inside. So you could have 1,000 Rand a month going into your retirement annuity, but you might have 4 different funds inside. So it might be invested into an income fund, there might be some property investment, there might be some equity and some bonds, and maybe some gilt funds or something like that inside your retirement annuity. So, and your fund will grow by the combination of the growth on each of these different funds inside your retirement annuity. Now, you are allowed to shift between funds in the retirement annuity. So let's say, for example, your bond fund is not performing well and you feel that you want to move it. You can move the money out of that bond fund into another kind of fund or another fund in the same sector. So there is that flexibility. Just be very careful, guys, that most of the time these moves, you don't want to move your money and try and stock pick. You don't want to try and pick funds to go in trying to ride the waves. When you look at a retirement annuity, it is a Welcome back, everyone, and let's continue with our article that we're discussing today. Why it's time to retire, this rule of thumb, and we are talking about the rule of thumb that 15% of your salary saved will give you a retirement, a comfortable retirement, and whether that is still reasonable or not. And I'm sharing my thoughts on what I think about their solution. So now, after we've spoken about all the bad stuff, let's look at what they say the solutions are for this. So, rewriting the rules. South Africans are cash strapped. For many, a retirement nest egg is their only savings. We're seeing more and more people cash out their pension or provident funds when leaving a job, preserving nothing for their later years. And yes, me being in the industry for so many years, definitely what we are seeing is that people are cashing out their pensions or provident funds. Treasury has been seen the dark clouds on the horizon and plans to introduce a two-pot system in a desperate attempt to keep the inevitable storm at bay. So yes, so what's happening is they are looking to create legislation where you will have two values basically in any pension fund. One of them, if you move, you will be able to cash out or get access to, and the other portion will have to wait until retirement, encouraging fund members to maintain some level of preservation. However, while Treasury deserve a thumbs up for this proposal, there will still be too little in the pot to comfortably see us through retirement. Guys, this is unfortunately the reality for over 96% of people in South Africa. There will still be too little in the pot to comfortably see us through retirement. So what options do we have? And this is their solution. We need to get realistic about contributions. So again, immediately they go towards savings. 15% will not leave us with enough money to retire comfortably at age 60 to 65. While contributing 30% or more of our monthly earnings is just not feasible for most South Africans. So in that paragraph, they basically saying that savings alone is not the answer. The same thing I've been saying for the last 23 years. 15% will not leave us with enough money, and 30% is not feasible or not realistic for most people. So if we cannot continue with work with traditional employers, retirees will need a side hustle or alternative income stream to see them through till at least the age of 70, stopping them from dipping into their capital. So what they're saying is, well, if you then retire, you need a side hustle at that point to supplement your income. Now, why do you want to wait until you retire to then create a side hustle and then still work for money? Still work because you have to supplement your savings. Start doing it right now and start building your passive income, your assets, so that you don't have to work for the money. You don't have to work because you have to. You can work because you want to. With that said, and that's the solution. That's it. With that said, it is clear that the retirement paradigm may need to be reconsidered in the not too distant near future if we are to avoid a Thumbelina retirement. So guys, that is their solution. So either save 30% from when you are 25 years old, or start working so that you can get a side hustle or an alternative income stream after you've retired. So basically keep working after you've retired. Guys, it's actually amazes me that this is the best solution that these people can come up with. And these are high ranking people in the industry. So this is why I created the 5-step program that we teach people. This 5-step program is as follows. The first step is invest in yourself. Make sure that you invest in your own education. You need to be educated about finances. And this is why I do Financially Raw, to educate people and help them to understand these things better, to know what to expect. Because you can't solve something if you're living in this dream world that if you have 500 Rand a month paid into a retirement annuity and you're putting money into a pension fund for the last 3 years, you in some miraculous way are going to have enough savings. You need to understand that that's not the solution. So educate yourself by investing in your own financial education. You need to start focusing on your budget so that you can have complete control over your finances, and you need to invest in getting rid of all your unsecured debt. So that's all investing in yourself. Step 2 is minimizing your risk, making sure that if anything does happen from now until retirement, you and your family can continue. Because that's the foundation. Things go wrong. You need to make sure that you are sorted out. Then we get to step 3. Step 3 is become an entrepreneur already now. Don't wait until you're retired one day. Already now start building business assets. But becoming an entrepreneur is not just doing a transactional business, more and more work. It's building business assets, and we teach people how to do that. Then step 4 is invest in income generating assets. So when you create this side hustle, this business asset that generates income, and you don't have control over your cash flow, then that money is just going to go into the pot. Your expenses will expand and you won't move any closer to retirement. So you first have to do these building blocks in the beginning so that when you start earning income from your entrepreneurial ventures, that money can start working to build assets for you and not just pay extra expenses. And you do that by investing in an income generating asset. What is an income generating asset? It is an asset that generates an income as a result of the asset, not what you do in the asset. So that's an income generating asset. And then you start building what we call the generational wealth spiral, where that asset generates an income. That income builds another capital asset for you with your income from your entrepreneurial venture. And once you have enough income, you go into another income generating asset, and you continue with that spiral until your income from all of your assets is equal or more than your income that you get from your job. And the moment you are there, you are financially retired. And you could do that in 10 years. Doesn't need to be 40 years. But the moment you start focusing on replacing income instead of saving capital, you're on the right track. Focusing on saving these large amounts of capital will never get you there, because the returns on investment on capital assets is not there. Secondly, you're not able to save the large amounts of money to get you there. And then the last step is about retiring happy. And step 5 we call pay it forward. Go and talk to other people. Refer them to our webpage so that they can come and see what we do. Send them to our YouTube channel. Just go search for I Retire on YouTube. There's all our educational content, because this is my way of paying it forward. This is my way of making a contribution to help other people understand what is facing them and what to do about it. Not pie in the sky, not saying, well, you need to get reasonable returns. We need to show you exactly what you need to do, because that's the only way you will get to solve your retirement crisis. And retirement planning and getting these things in place doesn't start when you are 50. It starts today. So don't wait for it. Contact our offices and listen and start implementing these steps. We have coaches that will help guide you to implement these steps. Okay, so we're going to play out one last song, and then for those of you who are watching, I'm going to see if I can finish the video for you so that you just see the problems or the negatives about retirement annuities, so that you understand the context of what to expect from a retirement annuity. And then I will chat to all of you again next week. Thanks, guys. Here is that video again. Cheers. Long-term investment. You want to go into funds that you choose and stay in those funds for as long as possible so that you can get the compounding effect. Because every time you move funds, you get hit by the buy-sell spread in a double whammy. So let me quickly explain what the buy-sell spread is. Whenever you buy units in a unit trust, or you buy shares in a share, or you buy Forex, for example, the amount you pay to buy that unit and the amount it is valued at that moment to sell it is not the same amount. Your buying price will always be higher than your immediate selling price of that specific unit. It is like buying a car. If you walk into the dealership, you buy your car for 100,000 Rand. If you walk out and you try and sell it back to that same dealership immediately, they're not going to give you 100,000 again. They'll give you 90,000 Rand. That's what they call the buy-sell spread. So what happens is, let's say, for example, your difference between your buying price and your selling price is 5%, just for an example. So you move your money from one fund and you're going to move it into another fund. That buying price is 5% less than what you're selling. That selling price is 5% less. So you're losing out on that. Then you go and buy in the new fund, and that's 5% less again. So you're basically losing out on about 10% with that move from the one fund to the other fund. So be very careful when you're looking at moving your fund so that you don't get bitten by the buy-sell spread. But you can move the funds from one fund to another fund. Another thing that's important is, guys, be very careful when advisors, brokers come and tell you to cancel a retirement annuity to start a new retirement annuity. More often than not, I would say over 90% of the time, the only person that benefits from cancelling one retirement annuity and moving it to another company is the advisor. It is not in your interest, it's in the advisor's interest, because he's getting to sell you another policy, which means he's getting commission on that policy. Be very, very careful of that, because what you cannot buy back is the time that you've invested in that product. So you lose that time that you've invested, and secondly, you're duplicating these initial costs of your investment, which negates a lot of the compounding interest effect that you might have received. So guys, if an advisor comes and sits with you, and all they want to do is try and move everything that you've got with one company, and we all know the D company that I'm talking about. So they all want to move everything into this one company, because if you have everything there, you'll get this bonus, and you connect this to that, and the knee bone gets connected to the thigh bone, and everything is all connected, and now it's in your benefit. Be very careful. It is most often than not, more often than not, it is not in your best interest. It's in the financial advisor's and the company's best interest. So really, really do your research. Get second opinions. Make sure that what you are doing is right for you. And that is why it's so important to educate yourself. You cannot be successful at investing, at building assets, if you are a passive investor. You cannot be successful if you don't know what's going on with your own money. You need to educate yourself so that you can become an active investor. I'm not saying don't invest in retirement annuities. Don't invest in structured products. I'm saying teach yourself, get enough information so that you can do it on your terms and not the advisor or the company's terms. Okay, so that is the retirement annuity. So another thing is, on a retirement annuity, when you do retire from the fund, you have limited access to the funds. So you cannot just take your money and go and invest it and buy 3 properties. You can only access 1/3 of your money as a cash lump sum, and 2/3 of your money has to be invested into an annuity, which we will be talking about now. So you can't just do with your money whatever you please. At least 2/3 of that money has to be put into an annuity. The 1/3 will be taxed. There is a tax-free portion. The first 500,000 Rand is tax-free, and over and above that, you will be taxed on that. And the 2/3 that goes into the annuity will be taxed as an income in your hands as you were receiving income at the moment. So the same tax laws that you are paying tax on your income at the moment will still work when you are retired and you're drawing income from an annuity. Another big thing with retirement annuities is that your retirement annuity always has to stay Regulation 28 compliant. So what does that mean? What that means is that you can't just put all your money into equities, for example. You are limited to how much money you can put into different funds or different sectors of the market. That limits your flexibility, which means you can lose out on great spikes in the market. So, for example, over the last year or so, after the COVID dip that we had, some of the equity funds have grown by 40-50% over the last 12 months. But through your retirement annuity, you cannot be 100% invested into equity. The maximum you can invest into equities are 75%. The maximum you can invest into property is 25%. the maximum combined between the two is 90%. So you can't have 75% in equities and a full 25% in property, because that will constitute 100%, which is not allowed. So you have to drop your equity if you want some property fund investment there as well. So there's all these regulations that limit you on the growth, and it's one of my pet hates is regulation 28, but I don't have time to really go into why I feel regulation 28 is a very negative thing for investors in retirement. Okay, so those are some of the negatives on your retirement annuity.
Financially Raw, Real, Authentic Wisdom with Lourens from Retire Rich and Happy. Financially Raw, Real, Authentic Wisdom with Lourens from Retire Rich and Happy.